Welcome back to the deep dive. Today, we're really going to get into it. We're looking at how institutional investors are feeling about digital assets. We've got the 2025 Institutional Investor Digital Assets Survey, plus some global reports on, utility and risk. Our goal here, to really trace how these assets are shifting. They're moving from just like speculation towards becoming actual financial infrastructure. We want to pinpoint where the big money is going and, importantly, how firms are trying to manage the risks that come with it.
Yeah, the timing is interesting, right? 2024 really set the stage. You had the Bitcoin and Ethereum ETPs getting approved, plus MiCA moving forward in the EU, regulatory clarity starting to emerge. So 2025 looks like it could be a cycle driven by something more solid than just hype. We're seeing real structural shifts. Institutions aren't just testing the waters now. They're planning seriously big moves.
Okay, let's unpack that commitment straight away. The survey data is pretty compelling. We're talking 352 institutional investors, mostly big players, over $1 billion in AUM, and the headline number, 86%. That's how many either already hold digital assets or are planning to allocate in 2025. That's huge.
It really is. And it's not just intention. Look at the follow-through. 85% actually increased their allocations back in 2024. About the same number are planning to increase again this year. But here's the really interesting part, the bit that signals a real shift. 59%, nearly 60%, plan to allocate over 5% of their total AUM to digital assets in 2025.
Wow, okay. Over 5%. That's not just a little side bet anymore, is it?
Not at all.
That moves digital assets out of that small, alternative, super high-risk bucket and makes it a real part of how they build their portfolios. That feels like the main story here.
Absolutely. And when you ask why they're doing it, especially the U.S. firms and hedge funds who are leading this, well, the top reason, no surprise, is chasing higher returns compared to other stuff. That's 59%.
Oh.
But interestingly, almost half, 49%, also say it's about investing in innovative technology. They see it as, staying ahead of the curve, future-proofing.
And that feeds into how they think about it, right? How they categorize it.
Exactly. We're seeing a big psychological shift. 44% of these institutions now formally label cryptocurrency as its own distinct asset class.
What does that actually mean in practice for a portfolio manager?
It means they're looking beyond just like digital gold or comparing it to volatile commodities. They're starting to integrate it into their models, thinking about how it correlates or doesn't correlate with stocks and bonds. Does it actually offer real diversification? Many think yes. It's a sign they believe this stuff is here to stay, fundamentally.
Okay, so they're getting comfortable, and that comfort's extending beyond just Bitcoin and Ethereum.
Yeah, definitely. I mean, almost everyone holds Bitcoin, 97%, and Ethereum, 86%. No big shock there. But the data shows 73% now hold one or more altcoins, too. So they are definitely exploring deeper into the market.
But how are they doing that? Are they diving right into the deep end, setting up wallets and managing keys?
Mostly no, not yet. And this is key to understanding their current approach. 60% prefer to get their exposure through registered vehicles, things like ETPs, exchange-traded products.
Right. So they want the price exposure, but maybe not the operational complexity?
Precisely. Does relying heavily on ETPs suggest they're still a bit wary of the underlying tech? Maybe. But it's a crucial step for financial adoption. It takes away massive headaches like custody, the tech complexity, counterparty risk, all the things that keep compliance departments awake at night. So they get the exposure they want, but someone else handles the tricky bits. It's like courage, but with a regulated safety net.
Okay, so the money's flowing in, often through these safer, regulated channels like ETPs. But what happens next? What's the actual use case driving adoption beyond just holding? That seems to lead us straight to stablecoins, doesn't it? And making transactions better.
It does, because when you look at traditional finance, especially cross-border payments, it's slow. It's expensive.
Yeah, I mean, we're talking maybe $25, even $50 for a single wire transfer. And it can take, 3 to 5 days sometimes?
Right. Now, contrast that with stablecoins. They can settle transactions almost instantly, like right now. And the cost.
Yeah.
Maybe under 10 cents.
That difference is just massive.
It's a huge incentive. And that's why we see 84% of institutions either using stablecoins already or seriously looking into them.
Yeah.
The main uses they're interested in, generating yield is big, 73%, but also just transactional convenience, making payments easier, that's 71%, and foreign exchange, 69%.
And the market seems to have learned from past mistakes, like with algorithmic stablecoins.
Oh, definitely. The lesson from things like TerUSD seems to have stuck. The successful stablecoins, the ones institutions are comfortable with, like USDC or Tether, are fiat-backed. They work more like digital versions of money market funds. They aim for stability, which is what you need for reliable payments.
So if the tech offers speed and stability, what's the main hurdle stopping every business from using them tomorrow? What's the bottleneck?
The biggest challenge is what we call the on-ramps and off-ramps,
Meaning?
meaning how easily can you convert your regular currency, like dollars or euros, into a stablecoin, and then crucially convert it back again. For a global business to actually use stablecoins day-to-day, say, to pay suppliers overseas, they need total confidence they can swap back to local currency instantly and cheaply. Building those smooth, reliable fiat gateways globally, that's the big infrastructure piece still needed for mass adoption in traditional finance.
Okay, that makes sense. Now, beyond just payments, the sources also talk about blockchain transforming other areas like trade finance. That sounds pretty different.
It is, but it's another area ripe for disruption. Trade finance has run on paper for centuries.
Yeah.
Bills of lading, physical documents getting shipped around, signed, filed. It's incredibly inefficient.
Lots of room for error, fraud, delays.
Exactly. Blockchain offers a different model, a distributed ledger, a secure, shared, unchangeable record of who owns what and where it is in the supply chain. There's an example of the Global Shipping Business Network, GSBN. They're using an electronic bill of lading, an EBL. It basically digitizes that whole paper trail, making data sharing instant and verifiable. It's not just faster, it builds trust.
And the potential impact isn't trivial.
No, not at all. The World Economic Forum put out an estimate. They reckon improving efficiency in areas like trade finance using blockchain could boost global trade by up to $1 trillion over the next decade.
Wow, 1 trillion. Okay, so the utility isn't just about saving a few bucks on wire fees. This is potentially macroeconomic.
And that scale, that idea of efficiency, leads us nicely into the next big area, tokenization, taking real-world assets and putting them on the blockchain.
Right, chopping things up. So 57% of the investors surveyed are interested in tokenized assets. What's driving that interest?
Primarily, it's about portfolio diversification. That's 65%. They want access to assets they couldn't easily hold before. And then 42% see it as a way to enhance how they actually build their portfolios, more flexibility.
So give us an example. How should we picture tokenization?
Okay, think about something big and illiquid, like a large commercial building, maybe an office block worth millions.
Hard to buy a small piece of that usually.
Exactly. With tokenization, you could theoretically represent ownership of that building as, say, thousands or millions of digital tokens on a blockchain. Each token is a tiny fraction of ownership, and because they're digital, you could potentially buy and sell them much more easily, maybe even instantly, on a secondary market.
So it brings liquidity to illiquid assets. What kinds of assets are institutions most keen on tokenizing?
The survey points to a couple of main areas. Top of the list are alternative funds, things like private equity, private credit, real estate funds. That's 47%. These are typically hard to get into, require large investments, and lock up your money for years. Tokenization could change that.
Then the other big one.
Commodities. 44% are interested there. Again, think about making exposure to things like gold, oil, or even agricultural products more accessible and transferable.
But it's not just about investing in tokenized assets, is it? Asset managers themselves are thinking about using the tech.
Yes, and this is really fascinating. 40% are interested in tokenizing their own assets, like their private equity or hedge funds.
Why would they do that?
Several reasons. Instant settlement is a big one. Increased liquidity for their own investors, and the ability to offer fractional ownership, letting smaller investors get a piece of the action. It could broaden their client base significantly.
This all seems to edge towards decentralized finance, DeFi. The idea of rebuilding financial services exchanges, lending, insurance, but on the blockchain without the traditional middlemen.
It does. And the institutional interest in DeFi is projected to explode. According to the survey, the percentage of respondents engaging with DeFi is set to triple in the next 2 years.
Triple? From what to what?
From about 24% currently involved up to a potential 75%.
Yep.
That's a massive leap of faith in the potential of DeFi protocols.
Okay, if the potential yields in DeFi are often so high and the tech promises efficiency, why isn't everyone already doing it? Why are almost 3/4 still hesitant today?
It really boiled down to two things, regulation and risk. The top barriers cited are regulatory uncertainty, that's 57%, and compliance risks, 55%. The issue is that right now, a lot of DeFi activity is still, well, self-contained. It mostly serves the existing crypto world. You lend crypto to earn more crypto, you swap one token for another. We're not really seeing DeFi widely used yet for real-world applications like, say, originating a mortgage or issuing a corporate bond. Because institutions have really strict rules, KYC, know your customer, AML, anti-money laundering. It's hard to square those requirements with the often anonymous or pseudonymous nature of blockchain transactions in DeFi. Until that can be reliably addressed, most big institutions will likely stay cautious.
Okay, let's dive deeper into those barriers. Regulation comes up again and again. The survey clearly shows the top concerns stopping institutions from going even bigger are the uncertain regulatory environment, that's 52%. And of course, good old volatility is still a major factor at 47%.
Yep, those two are always near the top.
But the institutions are quite specific about what regulatory clarity they need most urgently. What are the key things?
Two areas really stand out. First, crypto custody rules. Clarity on how regulated institutions can safely hold these assets for clients, that's critical for 50%. And second, almost tied at 49%, is the big question. How should digital assets be treated legally? Are they commodities, like gold, regulated by one agency? Or are they securities, like stocks, regulated by another? That classification has huge implications.
Getting clarity on those 2 points seems like it would unlock a lot.
It absolutely would.
Yeah.
But the challenge for regulators is, well, it's tricky. Some aspects of DeFi, particularly the anonymity, create unique risks. When developers can be anonymous, there's less reputational damage if things go wrong. Unfortunately, that can increase the incentive for bad actors to take huge risks, leading to things like rug pulls where they just vanish with investors' money.
Right, which makes regulators nervous.
Understandably. And it also highlights that regulation needs to be global, or it just doesn't work effectively. Look at the Danish example. Back in 2019, Denmark tried to crack down. They made domestic crypto platforms report user transactions.
What happened?
Investors who valued their privacy just left. They immediately moved their trading activity to foreign platforms outside Danish control, permanently.
So unilateral action just pushes the activity elsewhere.
Exactly. It shows you need international coordination. Things like the OECD's CRF, the Crypto Asset Reporting Framework, are trying to address this, getting countries to share information. But it's a slow process.
And this difficulty in applying national rules to a global borderless system, it leads to a bigger potential problem, right? Something the Bank for International Settlements is worried about.
Yes, they call it crypto-ization. It's a particular concern for emerging markets and developing economies, the EMDEs.
What is it exactly?
It's when people in a country start widely using cryptocurrencies, or more likely, stablecoins, instead of their own local currency.
Why would they do that?
Usually because their local currency is unstable, maybe high inflation is eroding its value rapidly. So they turn to something perceived as more stable, often a US dollar-pegged stablecoin.
But that creates problems for the country's government.
Big problems. If large parts of the economy stop using the local currency, the central bank loses its ability to manage the economy through monetary policy, like setting interest rates. It can destabilize the entire macroeconomic picture. The BIS sees it as a potential systemic risk.
Okay, but hang on. This raises a really important point, doesn't it? While regulators in developed economies worry about systemic risk, what about the people actually using these stablecoins in those emerging markets?
That's the fundamental tension here. You've hit the nail on the head.
For them, it might not be speculation at all. It could be survival.
Precisely. Take Argentina. You've got inflation running at over 100% per year. The peso is losing value incredibly fast. So ordinary Argentinians are using USD-pegged stablecoins, like Tether, USDT, just to preserve their savings. It's a hedge against hyperinflation. It lets them bypass strict government controls on accessing dollars and avoid the risky black market for currency.
It's a financial lifeline.
It absolutely can be. Or look at parts of Africa. Banking penetration is low. Maybe only a third of adults have a formal bank account. In places with high inflation, like Ghana recently hitting 45%, stablecoins offer a way to protect purchasing power. And they're also being used for remittances, sending money home from abroad, because it's often way cheaper and faster than traditional services.
So what one government sees as a dangerous crypto-ization threat,
Citizens in another country might see as essential financial inclusion, a tool for stability when their own system is failing them. It's the same technology, viewed through completely different lenses. Hashtag outro.
Okay, so wrapping this up, if we try to distill the key themes for 2025 from all this, what are the main takeaways?
I think there are three main threads. First, definitely broader institutional involvement. They're moving beyond just Bitcoin and Ethereum, getting more comfortable with altcoins, and seriously eyeing DeFi, despite the risks. Second, real-world utility is driving adoption, especially for stablecoins and payments and tokenized assets for efficiency and access. The theoretical benefits are starting to translate into practical interest. And third, everything hinges on regulation. Getting clarity, particularly around custody and asset classification, is seen as the key to unlocking the next wave of major institutional investment.
So it feels like the market is being pushed and pulled by two strong forces. On one hand, you have the opportunity, the lure of high returns, efficiency gains for the established financial world. But on the other hand, you have sheer necessity, people in emerging economies using this tech because their traditional options are failing them, offering stability they can't find elsewhere.
Exactly. It's opportunity meets necessity. And that leaves us, and you listening, with a really challenging final thought to ponder. You have this deep tension. Citizens in many developing nations are using stablecoins for basic financial survival, for inclusion, for stability. Yet governments in advanced economies and global bodies are increasingly worried that this very adoption, this crypto-ization, poses a systemic risk to the global financial system they oversee. So, how can regulators possibly square that circle? How do you balance protecting the stability of the traditional financial system with the undeniable demand for these alternative tools in regions facing economic volatility? What stands out to you as the bigger challenge here? Is it the potential risk these new technologies pose to traditional finance, or is it the risk to the unbanked and financially vulnerable if access to these tools is restricted or shut down? Where should the priority lie?